This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion.
Today on the show, I have Alpesh Patel, and Alpesh is an asset manager, and he has been writing for the Financial Times for quite a long time. You can find him at alpeshpatel.com, and I think you're going to enjoy this. We kind of cover a lot of different topics, and even though his book has a focus on spread betting, the style that he talks about, the strategies that he talks about are going to hit home with the trend-following, momentum-style traders and investors. So I think you will enjoy this. So I was trying to think, the first time we exchanged emails, man, it was probably over a decade ago in some capacity.
Yes.
A long time ago, back in the day of really formative internet world stuff.
Yeah. How are you doing? Which country are you in at the moment?
I'm in Saigon.
Lovely. I honeymooned there many years ago.
It's quite the place. And I think maybe folks in the UK and Europe have a better feel for it. I think most Americans are generally surprised. And when I get here, I'm kind of surprised they're not more in tune with it, because it's a really interesting city.
Yeah, well, I was there a long time. It's been 16 years ago, so it must have changed a lot. And I'm flying out to Laos in 2 weeks, actually. So I'm looking forward to being in that region again. Stop by
for dinner. It's a quick flight. It's got to be.
I thought about going back to Vietnam, but I thought to myself, I'll sort of go somewhere completely different. It's similar, but a country I haven't been to. But you've been out in the Far East for quite a while now.
Yeah, I got on a plane out of LA February 1st. And so I decided all the places that I was at, Saigon just seemed to fit me the best. And so for right now, I'll give it a whirl.
That's excellent. That's absolutely phenomenal. I just downloaded the book, The 4-Hour Week, and I'm starting to think to myself, because everyone says to me, why do you not make more use of the fact you're self-employed? You could actually work from anywhere. And you just get into this mindset of thinking, I have to sit in an office in front of my computer, and you don't actually.
Yeah. And what's nice too is when you do those travels, and no matter how much you think you can maybe watch Anthony Bourdain or something and read a book, it's nothing like showing up in person. When you show up in person, something happens. Something happens. I still think back to the day, I'll hear criticisms from people about London. And I remember when I lived there for about 6 months, a long time ago. And, at the first couple of weeks, you're kind of like, And then once you get in that groove, you're like, oh, I like this place.
Yeah. I think there's something special about living in a country you're not raised in and from, because it's an adventure, it's something new. Whereas we who've been in, wherever you've been brought up, you get used to it a bit, and you get complacent, you take it for granted. Whereas where you move to somewhere, even temporary for a few months, it's all exciting, it's all different, and it's a little adventure playground. So I will. I'm going to continue following avidly on Facebook the travels.
Yeah, I don't know what the next plan is for right now, but for today, we are going to talk. We're going to talk a little bit about how to win at spread betting, which is your book that's out, and the subtitle: An Analysis of Why Some People Win, Some Lose, and How You Can Be a Winner. By my guest today, Alpesh Patel. And for those that are not familiar with him, maybe in, let's say, the U.S., I think a lot of people in the U.K. and Europe probably are, been writing for the Financial Times for a long time and runs his own fund and has appeared everywhere on the requisite channels and countries, Bloomberg, making the appearances in Hong Kong, Singapore, Beijing, and easy to be found at alpeshpatel.com. So tell me about, before I even get into a bunch of questions, which I have some, I think the most interesting thing for me is the focus on the instrument, which is an instrument that perhaps people in some parts of the world are not very familiar with, but it's an instrument very popular in the UK, for example. But then I think also the thing that you do in there, which hits close to home for me, is you go down a style direction for spread betting that is right in my wheelhouse. So tell me how you came to connect these dots.
Sure. Well, let's take the instrument first. Actually, it is, for the rest of the world, they can just think of it like a stock future. So a cross between owning a stock and owning a futures contract. So you're still doing the same thing. You're buying low, selling high, or selling high, buying low if you're shorting. The principle is the same. It's just that thanks to a quirk in English law, all the profits are tax-free. And that's because it's just the contracts are written in a way where it's a bet and not actually owning the underlying physical asset. But the lessons for those in America or those in other countries where they don't have spread betting are exactly the same, whether or not it's spread betting or whether it's share trading or whether it's futures trading. So that was the underlying aspect with this. And the reason why the book came about was that I had access behind the scenes, as it were, into the data of a brokerage, a spread betting brokerage, because I'd created my own white label. So through our clients, we were able to see hundreds of thousands of trades and note their behavior, what they were trading, the timeframes, who was profitable, who wasn't, what. And then we're able to sort of run, I know big data is a fashionable term nowadays, but we're able to crunch all of this data because obviously computing power being what it is, and get some clever statisticians in and to see if there were correlations and links between the winners and the losers, and then tie that up with some academic research as well to see if it all fitted in and made sense and what we could draw out of it. So that's the reason why we did it, because there are so many books there by traders, of course, but I haven't seen one where somebody's gone behind a brokerage and said, look, let me tell you who's really winning and losing and why, and let's look at all of them. Retail traders, not just the heroes, not just the George Soroses of the world, but the regular folk, and see which one of those is winning and losing and why they're doing it.
Well, let me ask you the first question. Which clients are winning and losing?
Well, what we found is that about 10%, only 10% were actually making money. And then we broke that down to see what things could we find that they had in common, and what did the losing traders have in common. And as you might expect with some of the things that the winners have in common, it's the things which the best traders in the world tell us. But there were also some quite surprising things that we discovered as well amongst the winning traders. I mean, let me just give you some snippets there. With the winners, as you would expect, they were systematic in their approach. Now, they might not have only had one system. Many of them used 2 or 3 different ways of looking at buying and selling, but on the whole, they were disciplined rather than just what a lot of the losing traders had in common was just, I read a newspaper report today or heard a rumor or whatever. Now, those kind of things you'd expect, that there'd be some element of discipline. There was an element of trade sizing so that they knew the kinds of things that you talk about on your excellent website, managing the upside to the downside, and making sure that there's more than a 1-to-1 ratio. In other words, the target for winning is greater than that for losing. And then the amount that if you were wrong, you do lose is only a small percentage, let's say 1 to 2% of your overall capital. Those kind of things you'd expect. And they were doing, on the whole, either they knowingly were doing that, or they were doing it having discovered it, not realized that actually this is what the best in the industry would actually have taught them. They just learned it by good practice. So those things were the things we expected. What came as a surprise was that that a lot of the winning traders tended to trade relatively frequently. Whereas, there's a lot of talk, and I'm sure you'll relate to this with momentum trading. There's a lot of people who poo-poo trend following who'll say, oh no, you just got to buy and hold. the only way to win is buy and hold. Except that we found that wasn't the case. What we found is that a lot of the winning traders were trading actively. They were momentum trading. They were trend following, and they were doing it frequently enough that this was statistically significant. It wasn't just, an accidental fluke that we found a few people who, just because you take large enough numbers, happen to win. They were doing this consistently, following those short-term trends without simply sitting back and buying and holding. And to get the data confirmation of that was quite nice to see.
No, but before you started, you did have a certain, I don't say this in a negative way, but you had a certain bias, a certain understanding about systematic strategies to begin with going in, yes?
Yeah.
Okay.
Yeah. I mean, when you're doing this kind of thing, look, it wasn't a PhD or an academic document, but I was mindful not to look for results, not to be biased through my observation and say, right, I want to find something which confirms my pre-existing views. Because again, you'll know from trading psychology, that whole problem of confirmation bias. In trading, we have a tendency only to pick out those data points which confirm our pre-existing prejudices. Of course, that leads us into losing trades. And the best way to describe how I sort of avoided that was, first of all, we just looked at the numbers and had statisticians and my co-author go through it, and then very tentatively draw out the conclusions. Because it's very difficult to argue against, when somebody's you can tell if people are winning or losing because you just look at their account size, you look at the profit they're making. Those numbers you can't massage or ignore. So it was easy to be objective, let's put it that way, for that reason. This is not to say that buy and holders didn't make money. It's just that given the periods we were looking over, they made less just because of the nature of the markets. Now, of course, if they buy and hold for 50 years, they may well do okay in line with the longer term markets. But what was interesting was that active traders who knew a few skills did do well, who had those skills to begin with, or were taught them, did well. Whereas those who tried to be active without the skills and know-how, of course, they lost money, and they would have been better off buying and holding for the next 40, 50 years or so on. But it's an unfair comparison to say to someone, if you don't have the skills, you should only buy and hold. What it is that momentum trading works as long as you take the effort to learn the principles behind it. You make a point there that I'm going off on a tangent here, but you mentioned that perhaps you might not get the academic credit for this insight that you were able to piece together using brokerage accounts and looking at that. And I think that's fascinating. I mean, it's a great idea. I've always wanted to get behind the scenes and find one of the legacy trend following traders with a 30+ year track record, like a Bill Dunn, and say, hey, would you let me just publish every trade you've made for 30+ years? And you kind of did something similar there. And I think it's really cool. And it reminds me of something not as extensive that I did years ago, but I was the first person to put into writing that John Henry was on the other side of Nick Leeson. And I still think from an academic standpoint, that's a really insightful type thing. But what's interesting is the academics sometimes they get caught in their own little world. And while this might not be an official license, this or that, I think the fact that you've pulled this data together, for those out there that maybe are biased, I need to see a, specifically formatted this and that and da-da-da-da. No, come on, just open your eyes. If someone does something cool and comes out with an insight, I know you don't care about the academic props necessarily. I think you see my point. It's And you'll have read some of those academic documents that come out, and they are so difficult to discern a practical application. That's the problem with them, because, everybody listening to this, you and me, we want to know, okay, how do we make money out of this? Whereas the academic doesn't care about that, of course. What they care about is, something which is going to be, almost trivial, to an actual trader. And so that was always all the way through my focus, as you say, with your research as well. The whole point was, okay, how does this then lead to some kind of application? So it's a very practical bias that I had, for the simple reason that trading means you've got to make some money out of it. So just simply having an insight wouldn't be of use unless I managed to get something tangible, which the readers or I could use in my own trading.
Since I know you're very comfortable with all kinds of directions, let me go off in one more side direction before we get back into the book. So having been at the Financial Times for a long time, and I've occasionally seen over the years some of the most prominent criticism of trend style and momentum style trading is from the Financial Times. I know not from you, but it's a lot of articles over the years that people can easily Google and find. Do you ever find yourself in-house having debates? And I just find it interesting. There's such a divergence that where you're writing for the Times, and then I believe the one guy's name is, and I hope I don't mispronounce it, but Philip Kogan?
Yes.
Yeah, he's completely on the other side of you, isn't he? I mean, he's not even on the same page.
Yeah, I don't think Philip and I tend to see that clearly on things. There was a competition a few years ago that the FT ran for people over a 1-year time frame to predict the level of the FTSE 100, and Philip and I were both competing in that, and I came within 0.5% of the final value. Let's just say Philip, with all his analysis, didn't. So I can understand why Philip believes in buying and holding for a very, very, very long time, because 1 year was clearly not his time frame. But you know, the problem with the arguments that people have with trend following, and it's not just the FT. It's ironic that actually you should mention the FT, because this morning I was on BBC Radio 4 and I was debating with another Financial Times colleague of mine, Martin Wolf. So I wasn't, because I was writing a weekly column. I'd submit my column to the paper, so I wouldn't be sitting in a room with them all arguing. But we'd meet up, we'd have the Christmas party, and so on. And so this morning on the radio with Martin Wolf, and we had very different views on capital adequacy ratios for banks and so on, but he was incredibly polite. Let's just say we're all gentlemen, even though we disagree. But when it comes to momentum trading, I think what tends to happen, as with a lot of these arguments, when somebody disagrees with a perspective, what they tend to do is put up a straw man. So they will put up an example of people failing at something which does require skill, does require know-how, and say, there you go, it does not work. Well, logically, that is a fallacious argument.
Yeah.
And with momentum trading, you and I and all those hedge fund managers know it works, except it requires some degree of skill. Just as if I said to you, being an electrician is a pointless activity, it doesn't work. Because here's 10 people who've just electrocuted themselves because they were untrained. It won't exactly prove my case that about the profession. And I think that's the problem with this line of argument, that actually the logic isn't applied very often by people.
I'll give you something I saw just recently in paper. Someone emailed me, and I forget the guy's name of his phone. He's been around for a long time. His last name's Taylor. And he put, it was in the FT actually, and he said something to the effect that trend following was dead. And I had a bunch of people write me, and they sent me the link, and they said, what do you think about this? So I went and read the article, and inside the article, he was giving all kinds of fundamental opinions about what might happen or what could go wrong here or this or that. And so I'm reading all this, and my first thought was to the people that wrote me, like, guys, have you bothered to just go to Google and find out who some of the successful systematic trend following traders are? First step. Yeah. And then maybe you might come across the name David Harding. And once you do come across the name David Harding, maybe you'll do a little homework, you'll read a few of his papers, you'll look at some of his performance. And it's amazing that people, when it comes to looking at momentum and trend following style trading, it's almost like they just draw a wall and pretend they don't exist. It's my final conclusion. They just want to pretend that, I mean, David has been very prominent in the last 5, 6, 7 years, but there's still a huge portion of the world just wants to pretend, oh, he doesn't exist, or trend following doesn't exist, or momentum doesn't exist. Yeah,
no, absolutely right. And I saw on your website you had a picture with him, and of course he's a legend. Yeah, if you're in the industry, I'll tell you 2 quick brief anecdotes about that. First of all, a dear friend of mine who's a lawyer at Gibson, Dunn & Crutcher works closely with him on this area. And I can tell you, you've got to be successful if you're hiring law firms like Gibson, Dunn & Crutcher. So never mind the fact that trend following works. You can actually afford expensive legal fees, so you must be good. But the other thing about AHL, David having been the H in AHL, which is part of Man Group, which is, de facto the world's largest hedge fund, actually, AHL within Man Group. And that's all trend following. The interesting thing about AHL is I was asked, about 3 or 4 years ago to be a expert witness in a lawsuit, where what was being alleged was that, MF Global had fraudulently deceived their clients. This had nothing to do with AHL, by the way, I should say, but just that a brokerage client the broker had lied without the knowledge of their employer and cost money to the trader client. And so I, as an expert witness, had to say basically trend following was on trial because the client was using trend following. And the judge wanted to know, had the broker told him the truth, would trend following strategy that he was using have earned him money? So I was in this case where I was the expert witness proving in the High Court that trend following works or not. And I'm not aware of any other case where it's been a matter of it's come to court. And the client who'd asked me to be the expert was the trader, and the barrister called me in. So counsel called me in, I think about a week into the trial, into his chambers and said, "We're really worried." And I hadn't come to court at that stage. And he said to me, "We're really worried because the other side just keeps on showing that our client, had he been told the truth and allowed to trade in his natural trend following way, that trend following doesn't work and he would never have made any money." And I started laughing. And I said, "Well, okay, I've got something you can tell the other side," because the other side was Man Group, the brokerage. They clearly, within even their own firm, have not heard of AHL and what it does. And so the barrister dropped this in court. And the other side were, of course, hugely embarrassed because it's very difficult to deny that your employer makes 90% of their profits from trend following, and you're saying it doesn't actually work. Well, what are you getting paid with? Disney dollars? So the person who'd asked me to be the expert witness won the case, won £21 million, which is about $35 million. And we've been good friends ever since, as you can imagine.
That is awesome. That is an awesome story. That's one of my favorite ones in my podcast yet. That is an awesome story. Now, I have to ask, is there a transcript that we could all read of all this? I believe you, but I would love to read the details.
Do you know what I've got? I actually have the expert report. I can dig up the expert report that I filed into court, which goes through why trend following works, which was provided to the legal team, and which is what led to the victory in the case.
If you want me to link it up and give it to you, I'll make a permanent spot for it, and people will pull it from you for time going on to infinity.
Yeah, I will make a note to make sure I dig that up.
That's a great story.
Email it to you. That's a great story.
I mean, it is. It's just classic. It's classic. And I hope the audience appreciates that. I hope they don't think that you and I are talking inside baseball. I mean, it truly is something where the content of your book, the strategy, the style that works, the momentum trend following strategy that you go inside your book and how to win at spread betting, it is something that's very misunderstood.
Yeah, and this is the battle that you and I think, have been fighting on both sides of the Atlantic, which is that people are missing out because they are misinformed about how to do it and the fact that it does indeed work.
Let me throw out some things that I saw in the book that I want to get you to comment on. Some things that are classic that people have heard, and since you've got an interesting perspective, I'll maybe let you run with it a little bit, but the idea, and if the average person hears this, it could be a doctor, it could be an attorney, maybe they've got a significant amount of money in the bank, but I still think the average person, if they hear the expression to bet small and cut your losses and let your winners ride, I mean, it's classic Wall Street parlance that goes back 100 years. But I'm not so sure the vast majority of the population really grasp that simple couple word phrase sentence.
That's right. And I think it's because they hear the phrase, but they don't know what it means and how to implement it. Because it's very easy to have an aphorism, and you and I know in other walks of life which require discipline, whether it's exercise or whatever else it is, something which I'm fighting with at the moment. You've got to think about the psychology. How do I execute this? What does it actually mean? And that's why traders will be very clear about the rules that they have, which implement those aphorisms. So they will say, okay, if I'm betting small, then that actually means that my exit point, the point at which I know I am wrong on a trade. Well, what does that mean? Well, this is what it means to be wrong on a trade because of the nature of the trade set up. Let's say it's based on the MACD or whatever it is. If it does this, then that must be the point at which I'm wrong. If I'm wrong, I could lose this. And if I lose this, it must be such that I don't lose more than 2% of all my trading capital. So they really drill it down into what it means, because when it comes to discipline, what it requires is knowing specifically what requires executing, and to be able to say, you're right, I must do this and must do that, almost to a micro level. And that's how we resolve that issue, is actually show examples over and over and over again. And you and I know, when you look at those hedge funds, that's exactly how they do it as well. They'll have that programmed in, hard coded in, all the way from the turtles, as you well describe on your website, very specific rules.
So why don't you talk about, though, because you mentioned in your book, why don't you give people some idea of, because you go into the winners where you look at the retail brokerage accounts, but you do talk about some of the bigger names. And we've mentioned David Harding, but you mentioned some of the other bigger names. And even someone like George Soros is a name that has just become so classically successful. And I think a lot of people love to debate George Soros today because they want to debate his politics. They're either for his politics or against his politics. Sure. But when it comes to trading, I think George Soros has made a massive fortune because he knows something about the trend.
Yeah, absolutely. I think what's interesting, let me talk about two. One is Soros. The other one is Bill Lipschutz, who I'd interviewed for an earlier book and took some of his lessons. He used to be global head of foreign exchange under John Goodfriend so if anybody who's read Liar's Poker, when Warren Buffett was chairman of Salomon Brothers. So an interesting figure there. Bill I'd interviewed out in London and in New York, and foreign exchange trader, trend following, very much into momentum and so on. But if we start off with Soros, and what was interesting with Soros, what was different with his most famous trade, the billion pound win against the Bank of England, was he was actually there using game theory. To some extent, he wasn't even using momentum trading. Of course, he was following the trend, but there it was a very unusual example of just using game theory and trading psychology. Because what he worked out is that, for those who remember that element of economic history now, I guess it is, because it's been 20 odd years, where what happened is the Bank of England said, we are going to raise interest rates to whatever level it takes in order to peg our currency to the German Deutschmark, as is pre-Euro days, just the way the Chinese yuan is currently pegged to the US dollar. And what Soros did, using game theory and trading psychology and behavioral finance, is said, well, for a threat like that you're willing to raise interest rates, a threat has to be credible. For a threat to be credible, I need to believe that you've got the firepower, the will, and the ability to actually sustain those high interest rates. So as soon as the Bank of England started raising them to 11, 12, 13, 14%, he said this isn't credible because the population won't stand for it, because their mortgages will quadruple overnight. There'll be a huge outcry, and these are politicians who are, at that time, we didn't have an independent central bank. These are politicians, and therefore going for votes, they will capitulate. So therefore the currency will drop. So he just reasoned forward as simply as that and started shorting sterling before the trend had actually really started. So that was an unusual lesson, because that, of course, same analysis in game theory can be applied over and over again. And that area of behavioral finance is often overlooked, but it's a very important one where psychology meets economics about credibility and threats. And it's become a very useful lesson during the Euro crisis, because the same principle applied when the European Central Government said that we will spend as much money as required in order to keep bond yields low. The fact that there it was different because they had credibility, because what they did is they spoke in unison and they said, we'll use unlimited amounts of money. And that was the difference. So these things are very important for us to understand so that we know which way to get in on a trade, of course. And that's the Soros example. With Lipschutz, he was the one who taught me about the win-loss ratios, making sure that whatever target you've got is always a multiple of the downside, and the 2% rule, that you don't lose more than 2% of your capital on a trade. The best line that I had from him, which I really like, is that you, and I'll keep it clean, you can't eat like a bird and dump like an elephant. In other words, you can't make small gains and then have huge losses. And that was the critical thing with winners and losers in my book that I discovered, is that they did a lot of the things which were very similar. One of the big differences was that the losers tended to have just a few big losing trades. And it was those big losing trades which often separated the winners from the losers. And the losers didn't know how to block those big losing trades. And that's the critical factor. So to some extent, the good news is it's very easy to churn from being a loser to a winner. You just have to get a handle on a few of those big losing trades.
As you talk about winning and losing and risk management starts to come up as a discussion. And you've got a little story, and I'll let you run with it. But it's a story, I believe, that maybe the author Van Tharp had originally published it. And I believe that Ralph Vance might have done it, which is the PhD experiment story in your book.
Yes.
And I forget the exact details are not at the top of my brain right now, but so I'll put the pressure on you. I'll put the pressure on you to outline the story. But it's a great story to get people to understand that while we're being very pragmatic in this conversation and we're going through certain details, a lot of very, very bright people don't get this.
That's right. So this experiment, and there's a lot of experiments can be done very easily in a classroom, was done with, I believe it's 40 PhD students. And each one was given a notional sum of money, and let's call it $10,000. And they were told that there are 100 rounds in a game, and on each round, they can bet any sum from 0 to the whole 100,000. And a coin will be tossed, and the coin is biased so that 60% of the time it'll come up heads and 40% of the time it'll come up tails. And if it comes up heads, then whatever they bet, they'll get double their money back, so 100% return. If it comes up tails instead, 40% of the time it'll come up tails, then they'll lose whatever they bet. Now, if you think about it, it's a stylized version of trading. You've been given a system which is right 60% of the time and wrong 40% of the time. So not a bad system, better than a 50-50 system, of course. And when you're right, you make a whole 100%. So not bad. Of course, when you're wrong, you lose all your money, but still not too bad. It's overall a profitable trading system, as you can see. And you would then expect people to make money on the back of that. What they discovered was, I think around 3 to 4 people only out of the 40 PhD students actually made money. And I often ask my, when I'm giving talks, I ask people, what do you think it was? Because it obviously wasn't that they didn't have a good system. People think the Holy Grail is always a system, but we've controlled that. We've said the system is given. Everybody has the same trading system, and the system is right 60% of the time. So you can't blame the system. And you've been given a sum of money. You've all got the same sum of money. So you can't blame that, I haven't got enough money or whatever else. And yet they still lost money. So what this clever experiment did is it showed us that it's not just about the trading system, but it's about the size of money you bet. And what had happened is all the losing traders at the end of the 100 rounds had basically bet too large a size. So out of the $10,000 starting capital or whatever it was, they might have bet, say, $2,000 on the first trade. Now, imagine they get, which is highly likely, 3 losing trades in a row. Well, they're down all of a sudden $6,000. So they've only got $4,000 left. So they've got to get on their capital of 4,000 just to break even. They've got to get more than 100% return all of a sudden. And what a lot of people don't realize is, first of all, how quickly you can be underwater. Because 3 losing trades could happen to anybody, 3 consecutive losing trades. And that's why bet sizing, keeping it small, is very important. What they also don't realize is if you go from 100, say down to 80, because you suffer a 20% loss, then a 20% gain with your remaining capital will not make you break even, because 20%, you'll need a 25% gain. So even though you've only lost 20% to get down to 80, you'd need 25% of your 80 in order to get back to 100, because you've only got 80 left, so you need a bigger percent. Now, people don't realize that. And the other little sort of mathematical trick they don't often realize with trading is, if you have $100, for argument's sake, and you lose 20% and then make 20%, you're still under your original 100. Equally, if you have $100 and you make 20% and then lose 20%, you're still under $100. And the point there, again, being the importance of making sure that, first of all, you don't lose. But if you're going to lose, which we all are, you're not losing large amounts. And the only way to control that is always to start with very small sums, because when you have to make that money up, when you have to make it back, you need more gains, more percentage gains. And as you and I know, and we mentioned Soros's long-term return is not even 25% per annum. And therefore, if we've got to try and get it, because we were down just 20%, we know it's going to be incredibly difficult to get 25% in a year. And therefore, if it's difficult to get 25% in a year, we better make sure we're not down 20% to begin with. And the best way to do that is to make sure that the trade sizes are small, and that we just keep on building them up a little bit at a time, a little bit at a time. And to some extent, it's just simple logic. We just lead people down that logic step by step, and then we confirm it by saying, well, this is what the world's leading hedge fund managers advise as well.
Yeah, I think back in the day, you would see, not you necessarily, but just in general, you would see people talking about 3, 4, 5% bet size, and I mean, you can be out of the game pretty quick at that. That's not. I mean, you can, and you mentioned a string of losers of 3. You could have a string of losers of 10 pretty quickly. It's not hard to come by. Listen, I got one more trading point to go, and then I'll let you go. I'll let you get back to your day. But one more thing that you made in the book, a point. If it's good at 100, it ain't better at 80, which is kind of an idea of losers average losers. Talk about that idea.
Sure, and you've got the great image on your website. So it sounds like I know virtually every picture on your website. There's that striking image.
I've got a lot of stalkers, and there are a lot of weird people around the world, and I might be talking to one of them. I'm going to have to get a whole posse of Vietnamese women's security now, just to protect me from English stalkers who write for FT.
Exactly. I trust they are beautiful Vietnamese ladies who are securing the perimeter, as I say.
I have a whole perimeter staff. There's
exactly. The thing with if it isn't good at 100, isn't better at 80. Again, this losers average losers was this point that you're supposed to add to winners, not to lose. So psychologically, we have a tendency of not wanting to lose, as opposed to a psychological tendency of wanting to make money. And they're two very different things. And because we don't want to lose, we say to ourselves, oh, I'm down in this stock, so let me buy even more of it so I can just break even. Of course, what you've just done is you've added to a position which was going the wrong way. So you've become more concentrated and less diversified in the one position in your portfolio which is losing money, as opposed to investing in one which is doing well. But also, the problem with this is you're not adding to the winning trade. So when the trend is in your favor and you could increase that position and the market has shown you, look, you've got a winning hand here, the trend is going with you, add to it, and then take off those additional positions if you wish, that's fine. But instead you do the exact opposite, because psychology and gut instinct is the opposite to what professional traders do. If it wasn't, everybody'd be a professional trader. And so it's that point, as you rightly say, is just because it and by the way, people will psychologically they'll come up with all sorts of reasons why they're right doing the comfortable thing, just as I will when I want to eat a chocolate muffin, come up with all sorts of reasons why it is not inconsistent with my diet to eat a chocolate muffin. And the same thing with this, they'll say, "Oh, it's gone down to 80. It must be even better now, mustn't it?" And that logic just does not follow because the market is telling you it's not.
But it's hard for the average person, because even though you and I might cover these topics, we are small lights in a very dark field, and the vast majority of people that are providing insights as to how markets and investing work would actually be saying the exact opposite of what we're saying.
Yeah, and it's why I think it's so underappreciated how important psychology is with trading, and you know, it's an academic area as well, is behavioral finance. And the British Prime Minister said after the last credit crunch, we simply do not understand enough about behavioral finance, because that was the root cause of the credit crunch, was that we didn't understand how people's minds work when it comes to money, and they work in very perverse ways. And not rationally at all. And until we get a grip on that, we can't become great traders.
Oh, I don't know. It looks like the U.S. Fed has fixed everything. I don't think there's any problems left. Everything's
they swept it all nicely under a very, very big carpet.
And there's a big bump under that carpet that sometimes moves and undulates and something. Listen, we've covered a lot of different things today, and people should go out and take a peek at the book, because it really is. It's the classic. Even though the title, How to Win at Spread Betting, doesn't necessarily speak to the idea of momentum and trend file style thinking, that is really, your book covers it pretty extensively. What would be the last takeaway that you might want to say or get across to the audience that either drove you or something about the book, the content? What else would you like to leave them with?
What I would say is, if you simply mimic and copy what the best in the business are doing. And the great thing about things like books and podcasts and your website is you can access what the best in the business are doing. We no longer have those walls where we think, oh God, how am I ever going to know what the best in the industry are doing? Thanks to things like the internet, we get people interviewing them all the time, and, you know, podcasts or whatever. If you copy what the best in the industry are doing, it's a very simple formula. You will get the same results as them. It's as simple as that. And it's the age old thing, which applies not just in trading, but all walks of life. It's just that people, again, they for whatever psychological reasons, they often don't take that first step to find out what the best are doing. And that was the point with the book, is to list those 10 things that the best in the industry are doing, so that people can mimic them and copy them and get the same outcomes. It's as simple as that.
Apparently, we've been leading parallel lives across the pond, parallel lives in terms of our mission and our insights, because everything you say, I'm kind of just doing the check mark of like, oh, I agree with that. I agree with that. This is, I agree with that. People are going to think this is like a Homer thing. It's like all set up. It's like, no, I actually agree with everything you're saying. So, but it's been fun. Listen, Alpesh, where can people best find out about you? The book, I'm sure, is available everywhere, but where can they best find out about you?
I'd say if they just visit alpeshpatel.com, everything's on there with lots of educational material, free videos, free information, just lots and lots of free educational stuff. Just, I say, like with your website, just tons and tons of free information.
Okay, well, good stuff. If you do make it to Laos and you fly through Saigon, drop me a line.
Definitely, no, I definitely will do.
I'll introduce you to my perimeter posse.
I was going to say, just to meet your perimeter guards. Absolutely.
Listen, Alpesh, it's been fun, and have a good day today.
Thank you. You too. Thanks very much.
Take care.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.